Tertia Jacobs is a Treasury economist at Investec. She joins me now on this. Tertia, good afternoon to you. I think almost everybody expected interest rates to stay on hold, so no one's surprised.
I see, Stephen. Yes, indeed. It was anticipated, and the speech, the statement elicited hardly any reaction from the market as well.
One of the things about this, which has been very interesting, is that the Reserve Bank governor says, as he said consistently for the last few months, that monetary policy at this stage, so interest rates at this rate, are restrictive. In other words, he's saying that the interest rates imposed on us by the Reserve Bank are actually holding the economy back. Now, I think he must be right, but it also shows you how scared he is of inflation, that the bank is using a restrictive policy.
Stephen, yes, and I think a good example is when you look back at last year, where the balance of risk assessment was constantly to the upside. And during the course of the year, many of these risks actually materialized. So the disinflation process actually had some setbacks and was slower, especially when you look at where inflation ended the year at 5.1% compared to earlier forecasts of about 4.5%. So for this year, when you look at the risks that the governor cited, there's the worry that some of these risks may materialize again, given the very high level of uncertainty externally as well as internally.
There's so much about this that we can't really control at the moment. Geopolitical tensions, supply chain shocks. We'll get to Transnet in a moment. But if you look at what's happening around the world, it's actually very difficult to predict any kind of change in inflation. In other words, the bank has to be prepared for difficult times.
So, Stephen, I think one must acknowledge that progress has been made in the global disinflation process. You know, last year the focus was on where was inflation going to peak and how fast this disinflation process would be. This year, we're looking at the last mile, especially in the G3 countries, of getting the inflation rates back to their target rates of 2%. So here, the same dynamic is playing out. Progress has been made. But now the last mile could be slower in the context of how these risks are playing out. And what becomes quite important for South Africa, and especially when you look at the rand, right, is when will the Fed, for example, start signaling that they are ready to cut rates? Because in December, we've seen them turning like dovish, indicating that rates may have peaked if the forecasts play out as they anticipate, but they have not really yet to signal rate cuts. And I think that's quite important for the Reserve Bank in the context of our current account deficit, of a high budget deficit, and the need to attract foreign financing because of our South Africa's low savings rate, especially from the government.
So you're suggesting we can't move until the Fed says it's going to move?
So the governor will not like it when I say that, because they very much focus on where inflation is heading. But I think a very important point here is we do look at the differential between South Africa's and America's short-term interest rates, you know, both in nominal and real terms. So that's when we adjust them for inflation. So I think the only time when our Reserve Bank can really move before the Fed, because they can, is when there's a higher conviction that our inflation is on the way to 4.5% on a sustainable basis. That's not impossible, but you need that signaling from the Reserve Bank because of low interest rate differentials.
We've seen such high inflation for a long time that people have become used to high inflation. The official phrase for that is inflation expectations. And the governor spoke a little bit about that today. Is that becoming quite difficult? People are used to high inflation, and that means that the bank has to work very hard to make sure that inflation stays low to reduce the expectation of inflation.
So that is very important because the Reserve Bank is trying to anchor inflation expectations at the midpoint of the target, which is 4.5%. Now, in South Africa's case, inflation expectations are also guided by historical inflation. So the longer inflation stays, to your point, at, say, between 5 to 6%, it continues to keep the inflation expectations at those levels. So the Reserve Bank really wants to see inflation coming lower so that your inflation expectations can also start to recede. So it's a bit of a chicken and egg dynamic here, because in the developed world, right, when you look at their longer term inflation expectations, those expectations are actually not far from their central bank's inflation targets, whereas in South Africa, it still remain higher. So it's very important then to get that message across that monetary policy will remain restrictive while inflation expectations remain high. Because the thing about inflation expectations as well, it starts feeding off itself. You know, it feeds into wage expectations. It feeds into higher price settings from companies. So that's a very important dynamic that the Reserve Bank remains focused on.
Do you expect then that there's still a chance that we'll have interest rates easing at some point this year? I mean, that was the expectation from many people. Is that still your expectation now?
Yes, Stephen, I do think so. There is the balance of risk assessment, and the Reserve Bank will remain data dependent, as the governor stated. So, you know, we have to pick a date. You know, we work in the financial markets. The markets have expectations. So we will continue to run with our baseline forecast unless, you know, some of these upside risks to inflation materialize, that the Reserve Bank perhaps can get going with the first rate hike around about May.
Thank you very much indeed. Tertia Jacobs is a Treasury economist at Investec.